Stocks and bonds are moving in the same direction, and if you're just about to retire and need to start living off of these dollars, very challenging time to invest. How should you structure your investments? Unique strategy, got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Obviously, it's been just a tumultuous year in the investing world. I want to say stock market, but what's uniquely painful about right now is stocks and bonds are moving in the same direction, and that's down, right? That's negative. Diversification is not helping you, and so it's a very tricky time. Even worse, though, if you're right on the cusp of retirement, because you're looking and saying, well, wait a second, I need to start drawing dollars. I need to start supplementing my income with withdrawals from my portfolio, and I'm not getting the diversification that I hoped for or expected or have seen in the past, where if stocks are going one direction, bonds are going the other, or vice versa. I mean, one of the most painful characteristics about this market downturn is that stocks are going down and bonds are going down as well. This is the worst year on record for a 60-40 portfolio, 60% stock, 40% bond. So if you're in retirement or just about to retire, how should you invest? Well, even though it's more challenging, there's a unique strategy that is presenting itself right now. So if you're just about to retire, here I would work with your certified financial planner, okay? So first and foremost, this is not advice, it's just an idea. Work with your CFP, see if this fits, but we're seeing this fit with more and more people. Number one, have 2 to 3 years worth of withdrawals in cash. So this is where you need to be doing comprehensive financial planning, because through that process, you've done your 5-factor retirement plan. You know, despite the volatility, you can retire with confidence. You've looked at what your spending needs are, and then you've looked at your income sources and made sure that those are in parity. So you know, this is how much I'm getting from Social Security, this is how much I'm getting from pensions or whatever sources, and this is how much I need to be withdrawing from my investments, okay? Once you know that much, that amount that you need to draw from your investments, multiply that by either 24, so 24 months, or 36, and that's the amount that should be sitting in your money market within your retirement accounts, okay? So those dollars should be lower risk. Why? Because if those are the dollars that you're drawing out of, you don't want a lot of volatility with those, because if the stock market drops another 20% before things recover and you're having to sell shares every single month or every couple of weeks in order to get the income that you need from your portfolio, you're doing reverse dollar cost averaging, selling more shares when prices are low. That's the exact opposite of what you want to do. In normal environments, you should have 2 years worth of cash. Right now, because we're dealing with inflation, and the Federal Reserve has not really come out with an official foolproof plan to land softly. I think they're doing a lot of just talking, trying to soothe the markets as opposed to actually taking action. And so with the possibility it gets worse before it gets better, and it takes longer to resolve than any of us would want, I would consider moving that from 2 years worth of cash to 3 years worth of cash. Therefore, you wouldn't need to dip into your investments or sell anything at a low point or panic or whatever for at least 3 years, because you've got 3 years worth of cash there in low risk, obviously low return as well, but low risk money market investments that you're drawing from. But then here's the secret, and here's the strategy that we're starting to see more and more. And this is a strategy we used to use 10 plus years ago, 12 plus years ago, when you actually could get decent interest rates. Here's the next strategy. That middle bucket, that second bucket in your personal pension plan, is income producing investments. Consider this. If you've got 2 to 3 years worth of cash, then take another 2 to 3 years, I'm recommending 3 right now for lots of folks, and put it in a fixed interest rate investment that will mature in 3 years. And you might say, and again, we've had this for about 12 years, where you say, I'm not getting any return on that. Why would I do that? Why would I lock up money for 3 to 4 years where I can't access it and not really get any good rate of return. Well, guys, we're starting to get a decent rate of return. You're starting to see better rates of returns on these fixed investments that even have a shorter maturity, 3, 4, 5 years. You're starting to get a more competitive interest rate. Now, is it keeping up with inflation, 8, 9%? No, it's not. But if you believe and if we hope that over the next couple of years, inflation will come back down to a more calm number, then locking in today's interest rate, even if it's for 3, 4, 5 years, would be tremendous. And because right now, it's very possible we see more pain in the stock market and more pain in the bond market as we're trying to figure out inflation, locking in a fixed rate of return could make a lot of sense. So think of this. You've got 3 years worth of cash, and then 3 years from now, you've got that fixed investment, maybe worth another 3 years that matures. And then that pays out with interest, and your principal goes into that money market and replenishes that money market that you just spent through for those 3 years. Meaning you've got 6 years, maybe a little bit more, depending on how you price it and how you structure it, where you don't have to worry about market volatility at all. And even though this is taking longer than what we want, and I'm mentioning, and lots of people are saying this could get worse before it gets better, could take longer than what any of us want, you've got 6 to 7 years where you wouldn't need to sell anything in your investments because you've got that much of a moat around your financial life. A different way to structure it is having that 2 to 3 years worth of cash, but then calculating what a 1 year worth of cash is and have that in a 3-year investment that matures 3 years out, and then another 1 year that's in a 4-year, another 1 year that's in a 5-year, and a 1 year that's in a 6-year. That's a laddered strategy where you've got your 2 to 3 years worth of cash in your money market, and you'll be drawing off of that. But then 3 years later, right as that money market is depleted, you've got another year that's deposited in there, and you can keep spending for that year. Then you've got another year that matures, and another year that matures. That ladders it out. Doing that, lengthening that, it's not going to get you a lot more interest rate, but will get you a little bit more interest rate because you've extended some of the maturity for some of those dollars. The big idea is doing that has structured it so that you don't need to worry about market volatility in the short term because you're drawing out of cash and you've got a couple years worth of cash. But if this does get worse before it gets better and takes longer to resolve than any of us would have wanted. Maybe it goes down and then we start the recovery process, but it takes a couple of years before that happens. You've got plenty of years to let your long-term dollars, the rest of your portfolio, the portfolio that you're going to be drawing on 7, 8, 9, 10 plus years out there, that primary goal is for long-term growth. You gave it time. You gave it that ability to ride through those ups and downs for that long-term appreciation because you've got your short-term cash flow fixed, and you've got an income, some income investments structured to pay out and that aren't tied to the stock or bond market. This is a deviation from the personal pension plan, something that we recommend as you're getting closer and closer to retirement. How should you structure your investments? Yep, you should have a personal pension plan. The short-term dollars, the money you need for 2 to 3 years should be in short-term investments. The money you need for the 5 or so years after that should be in income-bearing or medium-risk investments. The money that you don't need for 8+ years should be invested for the long term. That's what you're going to have invested up and down in the market, that sort of thing. So this is a deviation or a slight adjustment to the personal pension plan, simply because of interest rates on these fixed investments are back and stronger. And if you can lock them in for a longer period of time where inflation might start coming down and you actually have locked in a return that's above inflation for a time period, fantastic, and certainly helps you avoid and manage today's volatility. Is that the right approach for you? Don't know. It's an idea. Work with your certified financial planner, though. Make sure that they're not just an investment salesperson, okay? They've got to be doing comprehensive financial planning for you to do that 5-factor retirement plan, figure out what your income sources are, how much you need to be drawing, and can really guide you and help you through that entire process. Cash flow absolutely needs to be considered. Taxes need to be considered as well. Other income sources. So you've got to look at all 6 areas of your financial life to see if this strategy or something close to it makes sense. Work with your CFP. If you don't have a CFP on your team that can help you with that, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.